Have you ever been to a party where there's an actual punch bowl?
I haven't been to very many parties. I don't get invited very often.
Apparently, the history of this is that there was, in fact, like a period of a couple of hundred years where this was, in fact, a thing at not just like, I picture like a high school dance, like a punch bowl. That's not alcoholic. But apparently this was a thing. Like back in the day, all like big social parties had this punch bowl with rum, and somebody would take it away when it would get too rowdy, which I think is a good segue to today's episode. You ready?
Let's do it.
Let's get the party started. For well over a decade, top American policymakers were obsessed with the U.S. balance of payments deficit and gold outflow. After the London gold crisis of 1960, the Eisenhower administration feared a complete economic meltdown of the Western alliance if the deficit was not ended. President Kennedy confessed that the payments deficit worried him as much as, and at times even more than, nuclear weapons. And Lyndon Johnson, despite his many other preoccupations, was haunted by the idea that if the dollar and gold problem got out of hand, a global depression could ensue. The dollar and gold question was the most important issue of American foreign economic policy from the late 1950s through the early 1970s, far more important than we have previously understood. Matt, that's a quote from a book that I think is pretty near and dear to both of our hearts, Gold, Dollars, and Power by Francis Gavin, and it's a perfect segue to the story that we're going to be telling today.
This is the only book that I've read 3 times.
3 times? Really?
I've read this book 3 times.
I think I've only read it twice.
I'm obsessed with understanding the balance of payments in general.
Yeah, we still don't. Nobody understands this.
That's right. Yeah, that's why I keep rereading it, trying to understand it. Because I think once you do, if you can, it summarizes pretty much everything about macroeconomics all in one equation.
Yeah, or life.
All of life.
Yeah, all of life. I think so. In part 1, we told the story of how Bretton Woods came together, right? And we tried to correct the myth that the Bretton Woods Conference was this collaborative kumbaya moment where the world came together to design this perfect monetary system, right? It was definitely not that. Actually, no one lives happily ever after in that story for a variety of reasons. But that's what we're going to talk about today. And so one thing that is super interesting to me about Bretton Woods is that the Fed is notably absent from that whole story, right? Like they're not particularly relevant to Bretton Woods coming together. But the Fed is actually a pretty critical player, probably the most critical player in navigating the Bretton Woods system as it was designed, and in particular the reality of operating in it, which it turns out was quite complicated. That paragraph in the opening from Gold, Dollars, and Power paints a picture, right? This spans 5 presidencies from Truman all the way to Nixon. One common thread that I think ties them all together is the person that is kind of battling to maintain the stability kind of over 2 decades. And that is William McChesney Martin Jr., otherwise known as Bill Martin. And he's actually the longest serving Fed chair in history. And similar to Harry Dexter White and John Maynard Keynes, he's a pretty fascinating character. And maybe more similar to White, actually. He's not as well known probably as he should be, I think. But he's the one constant, across this eclectic set of presidents and treasury secretaries and sort of policy dynamics that are playing out. Another point, in stark contrast to somebody like Harry Dexter White or even John Maynard Keynes, Martin is interesting because I don't think, we talked a little bit about Keynes being driven by ego. White definitely has a bit of a bit of a streak of like power seeking for the U.S. And of course, there's the whole espionage thing. Bill Martin, I don't think is looking for credit, he or power or popularity. I think in a lot of ways, he's in it to make the world a better place, or maybe better said, he's in it to prevent the world from falling apart. Like, I think he would make a great credit investor, right? He's got like a little bit of a pessimistic outlook on macro. If this were Game of Thrones, did you watch Game of Thrones?
Some of it, not all of it.
I think he would be like the Ned Stark character. I was going to say Jon Snow, but I think he's more of a Ned Stark. Maybe spoiler alert. if anybody out there has watched Game of Thrones. Why don't we tell a little bit of the story of his background? Let's start with who was Bill Martin. So let's give a little bit of background. And I think his family in particular, his family history plays a big role into his development. So his grandpa in particular, his grandpa loses his grain storage business in the financial panic of 1893. And believe it or not, this is a crazy statistic that I ran across. Apparently, the U.S. economy was in recession 55% of the time between 1893, so when this panic takes place, through 1913, which coincidentally is when the Fed gets started. And that's all significant because Bill Martin's dad is highly influenced by this panic of 1893 that basically takes out his dad's business. There's a lot of kind of family trauma, I think, in this. Ultimately, Bill Martin's dad goes on to become a lawyer, and after a few years, he becomes the founding president of the St. Louis Fed, which sets up Bill Martin with kind of a front row seat at the dinner table to learn about finance and banking, and in particular public service. And I think, given his family history and the way his dad approaches life and his profession, I think this imbues him with this very interesting combination of a work ethic and humility, a lot of integrity, but maybe the two critical things. One is a love for public service, which was really big in the household. But another one, which I thought was kind of fun, is this idea of the importance of reasoned kind of civil disagreement and debate. And apparently at the dinner table, I don't know if you read about this. Apparently at the dinner table, all the kids in the household were encouraged to like push back when they were having like policy arguments and things. And apparently the phrase is, "Sir, I perceive you are in error," which is kind of fun.
One comment there, right, on the number of recessions between 1893 and 1913, right? Like, this is why the Federal Reserve was created, right? A lot of those recessions were blamed on banking panics and runs on banks. And so this percentage of time that we're in recessions during this time period is actually why the Federal Reserve was created. And what was the year of its creation? Wasn't it
1913? Yep, exactly.
Yeah, exactly.
Yep. And so, Bill Martin, so now we're fast forwarding a little bit. Bill Martin kind of grows up. He goes to Yale. He graduates in 1928. He quickly rises up the ranks of a brokerage firm and lands at the New York Stock Exchange Board of Governors in 1935. So he's pretty young. Not only that, but then in 1938, at the age of 31, he gets elected to be the chairman of the New York Stock Exchange with a mandate for basically reforming it as an institution. And to put it into context, basically at the time, the exchange was kind of not a very transparent place, and there was rampant fraud and embezzlement and other things. And so he's basically charged with the task of professionalizing it and making it more sophisticated in a way that makes it more trustworthy, makes it operate like what we might expect today, a traditional stock exchange. Or maybe those are fighting words for somebody out there that might disagree with me. If anybody's read some of Michael Lewis's work on this stuff. But anyway, his nickname is the Boy Wonder of Wall Street, right? He's 31. He's the chairman of the board at the New York Stock Exchange. And from there, he eventually makes his way to the Treasury in 1949 during the Truman administration. And he actually holds the same position as Tim Geithner is eventually going to hold, later down the line before he goes to the New York Fed during the global financial crisis. Same position that Neil Kashkari has during the global financial crisis. Neil Kashkari famously is the architect of TARP. And then a position that is kind of adjacent to, the position that Paul Volcker is going to have when we talk about him in a future part of the series. But at the time, so this is, 1949, 1950, the Korean War is underway, and that kind of makes Bill Martin's career. And the reason for it is that up to this point, the Fed really, for the last couple of decades or so, decade and a half, has really been subservient to the Treasury. And the idea there is that the Fed was sort of the money printing machine for the U.S. government to be able to finance their participation in World War II. And the chairman of the Fed at this point is a guy named Thomas McCabe. And Truman had appointed him and expected him to be pretty constructive and almost, effectively continue that relationship with the Fed, where the Fed is almost another arm of the Treasury, helping to finance the government. And McCabe is not that. McCabe actually tries to be what we might consider a more modern Fed chairman fighting inflation. And so there's a lot of conflict. And Bill Martin actually ends up being the guy that steps in from Treasury to try to orchestrate something, some sort of agreement or compromise between the Fed and the Treasury and the government. And he actually orchestrates what's referred to as the 1951 Fed-Treasury Accord, which secures Fed independence, which we all kind of take for granted today that the Fed should be independent, but that wasn't the case until 1951. And Bill Martin is kind of the architect of the idea of Fed independence. Now, it's not necessarily operationalized yet. There's actually a great quote here from one of the books that I read for the series called Chairman of the Fed by Robert Bremner. And the quote is this: "The Accord takes its place alongside the Banking Act of 1935 as one of the monumental events in the history of modern Federal Reserve System. The Accord was constructed around the recognition that the Fed's responsibility for controlling credit and the Treasury's responsibility for managing its debt could come into conflict. To assure that the actions of the two institutions would be in the nation's interest, both had to recognize one another's institutional responsibilities and to act as partners and equals." So, Matt, I don't know. I mean, I think if anybody's been keeping up with the news, this is highly relevant to today.
For sure. And one thing I think is just worth mentioning, right, is that the Fed wasn't just sort of de facto subservient to the Treasury during World War II, right? Interest rates were fixed during this time. They were managed at low rates to finance the war, and so the Fed really just was sort of the money printing arm of the Treasury during that time. And then this accord that Bill Martin secures for Fed independence, most other central banks in the world weren't independent from their governments until the 90s and 2000s. So this is some very forward thinking around governance and diplomacy by Bill Martin here. He's 30 to 50 years ahead of other central banks in terms of securing independence for the country's central bank.
Yeah, and I think that the idea that central banks should be independent is out there. People understand that there's a certain dynamic of incentives that if a central bank becomes politicized, that's going to lead to short-term potential, benefits politically, but of course long-term ruin. And so I think Bill Martin brings that as a policy dynamic and ends up putting it in place. Funny enough, like he does that during the Truman administration, and then McCabe, this guy Thomas McCabe, who was the chairman of the Fed, had written a resignation before that accord gets struck because of all the conflict with the Truman administration. And so Truman, immediately after the accord, actually ends up taking him up on the resignation and nominates Bill Martin to be the next chairman of the Federal Reserve. And as a side note, as the Truman administration is ending, apparently Truman or Bill Martin runs into Truman, I think in New York somewhere, and he says, "Hello, Mr. President." And apparently Truman just looks at him and just calls him a traitor and moves on, because Truman expected him to have a little bit more of a constructive outlook. And Martin becomes the true Fed chairman, like defending, the value of the dollar and stability, et cetera. So that brings us to Eisenhower. So Eisenhower took over in 1953. Military spending at this point had increased about 4x, and defense is about half of federal spending. And Eisenhower actually won the election. So you might remember, right? Like Truman was a Democrat, FDR was in office for a really long time. So Eisenhower, as a Republican, wins the election on the idea of balanced budgets and economic conservatism. And so he gets to work in trying to control some of this. Bill Martin, meanwhile, had been operationalizing Fed independence, and he restructured, open market operations. He starts to convince the other members of the Fed to let the market drive long-term rates, which before this, the Fed was highly influential across the whole curve of interest rates. We tend to think of them today as controlling short-term interest rates, but before this, they were influential across the whole curve. And most of all, Martin gets to work battling inflation, which at this point becomes the primary focus of the Fed. And inflation had started to rise a bit. So it's starting to creep above 3% by the end of 1955. And around this time is where he gives a fateful speech that doesn't make a lot of headlines, but he says the following during that speech, and this is going to become very famous, and it's sort of what we think of today of the Fed. He says the Federal Reserve is in the position of the chaperone who has ordered the punch bowl removed just when the party was really warming up. And the context of that phrase is that he's basically saying, look, the Fed is not always going to be popular. In fact, a lot of times people are going to boo the Fed because it's removing the punch bowl as the party is really getting going. But that's the whole point of the Fed. The Fed isn't there to be liked. The Fed is there to effectively try to stabilize the system and make sure things don't get too out of whack. And it's debatable, how successful they have been over the years at that. But the administration, notably a character that's going to play a big role later in the episode, the chairman of the Council of Economic Advisors, Arthur Burns, is kind of worried about an economic downturn heading into the 56 election. And in April of 1956, the Fed actually announces another rate hike, which makes the Treasury lose their mind. And Eisenhower actually considers going public with comments scathing to the Fed. Martin meets with Eisenhower. He holds steadfast. He has a pretty diplomatic meeting, but he's basically saying this is the right thing to do. And ultimately, interestingly enough, because this is kind of in stark contrast to maybe modern times, Eisenhower actually decides to back down. And he ends up being a critical figure in Fed independence because a reporter apparently asks him around this time, what do you think about making the Fed report to the president? And Eisenhower's response is, it is not under the authority of the president, and I really personally believe it would be a mistake to make it definitely and directly responsible to the political head of state, which ends up adding, a ton of credibility to this idea that the Fed should be independent, right? Eisenhower is this really big figure in America at the time, this sort of legendary general from World War II. And so it's kind of a nice touch that propels Fed independence forward.
I think it might be worth, as we kind of move into the 50s and we make some comparisons to today, right? It's worth just pausing and acknowledging that this was a totally different economic setup than we're in today,
right?
From a growth perspective. The 50s specifically, but really the 50s, 60s, and 70s had productivity metrics that were just on a different planet than they have been since then, except for a short period in the late 90s. And you had an explosion in population, right? The baby boom.
Yep.
Right. And so when you think about all these issues we're going to talk about going forward, whether it be Fed independence or societal issues, they're really, I think, probably made easier to deal with because we have, what is growth, right? Growth is population growth, specifically in the workforce, and productivity growth. The
exactly.
more productive workers equals more growth. And so this time period that we're studying here, the 50s, 60s, and early 70s, really kicking off where we are right now, we have this boom in both productivity and workforce population. That's in the and a boom in oil production, right? Which is kind of a sub component of productivity that's worth mentioning. But just as we get into the 50s, important to keep in mind that the economic backdrop for growth was just fantastic.
Yeah, it's a fascinating period because in a way that it helps a lot, but it also makes things less stable. One key development in 1958 is that U.S. gold is draining at an alarming rate. And remember from Bretton Woods that the whole monetary system at this point depends on the dollar, number one, and two, the gold backing those dollars. And just to put some numbers around it, about 10% plus or minus of U.S. gold dollar reserves are being drained per year around this point in 1958. And the reason for it, or the problem sort of driving this, is that there is a ton of military spending that the U.S. is funding in Western Europe, right? They still have a big military presence, particularly in Germany. There is a big trade deficit with Western Europe. Now, notably, the U.S. has a big trade surplus overall with the whole world, but with Western Europe in particular, which is the most relevant piece here because dollars are flowing out, the Western European economies have recovered quite a bit by this point from World War II, but they still have a lot of trade barriers, and so they're exporting a lot more to the U.S. than they are buying from the U.S. So that's creating a bit of a deficit issue. And then there's a lot of investment flows that are going into Europe from the U.S. because post World War II, there was nothing, but there was this sort of like latent capacity from all the people coming out of World War II and everything that needs to get rebuilt. And so the U.S., as opposed to today, where a lot of investment flows, maybe, going back a year or two, but really for a couple of decades, investment flows have really been flowing into the U.S. because everybody thinks that's the best place to put your money. At this time, it's actually in Europe because that's the biggest growth economy in the world because everything needs to get rebuilt from scratch. And so, that is sort of the main issue in the Eisenhower administration. And in particular, the troops issue, the troops in Western Europe, ends up being kind of the linchpin across economic and foreign policy at this time. And you can't really withdraw troops and risk a Soviet takeover, or, that's how they thought about it. But you also can't afford a military presence because you're risking a run on the dollar by running deficits and basically flooding the world with dollars. And so there started to be market rumors that the U.S. might devalue, and so that $35 per ounce might go higher, and the dollars are going to be worth less. Side note, actually, did you read this piece where apparently Eisenhower suggests that maybe the right commodity to back dollars should be uranium at this point rather than gold?
That. Yeah. Yep.
Which is kind of wild to think about, but of course that doesn't come to pass.
And the on top of the military spending, I believe in Europe was all the Marshall Plan spending as well.
Exactly.
Right?
Yeah, all the foreign aid going into Europe. Yep, that also drove the deficit. There's a lot of capital flows going into Europe as part of foreign aid.
And the recovery of the economies, specifically in Western Europe and Japan, happened way faster than anybody expected, right? And so what's happening really in the late 50s, where we are, is you have companies that are all of a sudden more, competitive to and potentially better than U.S. companies.
Yeah,
and that happened way faster than anybody expected.
Yep,
which is just causing, and on top, kind of back to the population stats, right? Like we have a growing population, we're turning into mass consumers, and we're buying, we're sending our dollars abroad to buy from European and Japan companies.
Yeah, and they have trade barriers in place, so it's not like they can buy from the U.S. And there's a lot of negotiations around this. But yeah, that's basically, what the new system in the late 50s. And so by the end of about 1960, it all comes to a head, and the combination of prospects for inflation and rising deficits, and then Kennedy, JFK is ahead on the polls in the presidential election in the U.S., and he's promising a lot of government spending. And so the price of gold actually breaks 35 in the open market in London and reaches 40 on rumors that the U.S. will devalue. And so Bill Martin actually goes and meets with his counterparts at the Bank of England and at the German Bundesbank, and he convinces them to match U.S. interest rates and sell gold on behalf of the U.S. to try to basically punish the people that are speculating on the price of gold, which ends up settling down the price. And it kind of leads to the first major international currency issue coordination that Bill Martin orchestrates. And that's going to set the tone really for the next, call it 10, 12 years, because that's exactly what's going to be happening almost on an annual basis, where somebody's currency, usually the pound, is going to have a big issue, and that has cascading effects on the dollar. And so they're going to have to go figure out how to solve this stuff. So
this was a tough time to be British. I'll just
very
say
tough,
that.
Very tough. Yeah, because actually, Matt, you mentioned that the European economies are developing, in Japan too, but like Britain is one which did not do that great during this time period. Like France and Germany did, but not Britain, not so much.
Right. Yeah. I mean, they're having to drop, from the late 40s to now, right? They're having to drop all their colonies basically, and they were earning income from those colonies, right?
Yeah.
And so now and so they have a debt to service with a lot less income now from having lost the colonies.
And they have issues too similar to the U.S. because they have to fund their military presence in the Middle East, in Asia, and they don't have nearly the economic power or economic output and productivity that the U.S. has. And yet they still have those giant military expenditures. And in fact, the U.S. is pressuring them to continue them because the U.S. can't step in. And they're worried that if Britain leaves those, that the Soviets or the Chinese might fill in that vacuum. and end up expanding communism, which of course is kind of part of U.S. grand strategy at this point, is to not allow communism to continue to take over other parts of the world.
Right. And on the point of gold movements, right? You mentioned 10% of gold is leaving the U.S. per year. My understanding is that there was very little actual physical movement of gold, right?
Right.
Like most of the gold was at Fort Knox, and in the U.S., that was part of the Bretton Woods Agreement, is that we, even if it's not our gold, it's mostly in our geography.
Yeah.
And when gold changes hands, right, when France or Germany has a lot of U.S. dollars and they demand it be exchanged for gold at 35 an ounce per Bretton Woods, for the most part, this is just like moving gold from one side of the room to the other.
Yeah,
Knox,
exactly.
Right, into the box that says France.
Yep.
Which must have made some of these countries super uneasy.
Yeah.
Right?
Well, isn't there a story where France actually sends ships to the U.S. and says, like, load my gold up, I want to take it home?
There are pictures, if you just go look around the internet and you just Google, or ChatGPT, right? Did France send a battleship to New York City to collect its gold? The pictures look fake. Like, I can't determine if the pictures are paintings or if they're real, because there's just this huge battleship sitting in the Hudson River, apparently there to collect its gold. It's wild.
Yeah. Give me my gold. Yeah. Going back to 1960, at this point, Bill Martin has been at the Fed for almost 10 years. And, he basically has navigated the U.S. from this fear of post-war economic collapse in the world and an economy that was really led by military spending during World War II to now, in 1960, stability and solid economic activity, mostly led by private consumption and private investment. And at this point, he's not sure that he can navigate the transition to a Kennedy administration. And he actually thinks about resigning, right? And he had a great relationship with Eisenhower despite some of the conflicts, but they were very aligned, both in terms of personality and character and in terms of politics. And so, Martin's looking around going, well, I just want to make sure that the Fed is taken care of, that the Fed as an institution survives, and I'm not sure I'm the right guy for a Kennedy administration to interface with. So the relationship actually starts out pretty cold and combative in the press. And so both of them actually suggest publicly that the other has a chip on their shoulder. And there's a lot of political and kind of public pressure for Bill Martin to step aside, which in turn actually fastens his resolve to not step aside, to kind of stay and fulfill his full term. And he says that would be maybe the best demonstration of Fed independence, and which is what he really cares about, to finish his term. And so he decides to kind of double down on his efforts to establish a constructive relationship with Kennedy. And the first meeting, Bill Martin shows up and he leads with an apology. He actually apologizes and said, Mr. President, I apologize for the comment in the press. And he's very diplomatic. And he had spent the last couple of weeks meeting with Kennedy's economics team and realized that he can have a really constructive relationship and be very collaborative with them. And so they end up finding a lot of common ground. I think Kennedy's very aware, and by now we've kind of mentioned in a couple of different places that Kennedy thinks of this deficit and the dollar issue as one of the two core issues in his presidency. So he's very aware that he needs economic stability. And so Martin and Kennedy basically go on to have a great relationship. And Kennedy's under huge pressure from these deficits. There are a lot of surplus dollars relative to U.S. gold reserves. I think basically there's about 40% more dollars than there is gold by this point. So, we started from a world in which during Bretton Woods, there's a lot more gold in reserve at the U.S. relative to the number of dollars outstanding. Now that's kind of flipped. And there's a lot of pressure also from kind of on a foreign policy angle with the Cold War. You've got the Cuban Missile Crisis. You've got Berlin, which at this time, there's a big fight with the Soviets because Berlin actually is part of East Germany. And, the Soviets want to control Berlin on their own. The Allies are worried that, if they leave Berlin, then maybe the Soviets will continue to take over all of Germany. And then at this point, I think it was like 1961 or something that the Berlin Wall comes up. And so a lot of troops still in Western Europe. But also, going back to what we mentioned, Charles de Gaulle, the president of France at this point, has a very different vision for Europe. And he's threatening to convert the dollars that France has on reserve into gold. I mean, de Gaulle is very worried that the dollars are kind of a ruse and they're giving the U.S. this exorbitant privilege. And I think actually, interestingly, Matt, you tell me what you think of de Gaulle. I think he's a great kind of historic figure, but at the same time, he's a bit more like Keynes in the sense that he's a bit more driven by identity and ego than maybe somebody like Bill Martin.
Do you know what made de Gaulle famous in World War II?
Tell me what no, I don't know where you're going.
So he I think was a general and all, senior guy. So good military guy. But my understanding is the thing that made him famous and kind of a hero was after France surrendered, he flew to London, which must have been a very dangerous flight at this time.
Yeah.
Right? Because they're just surrounded by enemy planes. Chances
Sure.
he makes it are low. But he flew to London with the express purpose of giving a speech on the radio saying that, France has surrendered, but this is a world war and this is not over, and we will come back, kind of thing.
Huh.
And that speech that he gave was like a major kind of moment of French nationalism, and is one of the main things he's remembered for.
Yeah.
But when you fast forward to the time we're talking about now, one of my main things on de Gaulle is we're at this point, we're looking at Russia, or really the USSR, as kind of the bad guys. But France was tough on us during this time, right? They were neutral. They were not necessarily on our side, right?
Yeah. They wanted to be independent, right? They basically wanted. I think they saw Europe at that time as almost like a colony of the U.S. empire,
right?
And they didn't want it to be that.
And so de Gaulle's visiting the USSR a lot. They have France and Russia are doing things together. And then I was surprised to learn that France basically dropped out of a lot of the military alliances during this time frame, right?
Yeah, including NATO.
They dropped out of NATO, and they didn't rejoin NATO until I think it was 2009.
Yeah, 2009 with Sarkozy, yeah.
It's wild.
Yeah. Well, they technically were still part of NATO, but they were not part of the military alliance of NATO, which I'm not exactly sure the nuance as to what that means, but it feels like they were just not. They would not participate, and they kicked all non-French troops out of France. Of course, the U.S. was the majority of those. But it's a big deal. I did not know that either before I studied this.
And it's dawning on me now that there was a lot of pressure to get the Europeans to cover more of their own military expenses during this time. We the U.S. are spending a lot of money having our troops over there. And it's dawning on me now that probably one of the main reasons that went on for so long is that we were afraid that France was going to kind of officially tilt toward to officially align with Russia.
Yeah, Russia and West Germany, right? Because I think both of them, both West Germany and France at this point, hold a lot of power over the U.S. They have a lot of leverage because they have a lot of dollars.
Right.
And so I think, yes, the Soviets, but mostly I think my read is that the biggest fear of the U.S. at this point is that France and West Germany are going to get together and form their own European bloc and effectively cut the U.S. out of the region, which I think there were elements in the U.S. There were certain segments in sort of U.S. leadership that would have been okay with that and wanted to be isolationist. But I think at this point, the U.S. is the world leader, and you are stuck with the fact that the dollar is the linchpin of the world monetary system. And so, being removed from Europe in that way would have been a massive loss for the U.S.'s ability to navigate and preserve the world order and sort of the balance of power against the Soviet Union.
Right. And two things before we move forward that I think are relevant. One is this is the time period, right, when you look at it on a graph, the late 50s are when Social Security spending in the U.S. starts to really take off, right?
Yeah.
So that's a major factor in the domestic economy. And then when you think about what's the one thing, curious what you think, what's the one thing that, the Bretton Woods countries hated about how it worked? And I think the one thing was that they were constantly importing U.S. inflation, right?
Yeah.
And so the way that that worked was, remember, Western Europe and Japan are now kind of they're rebuilding. They have great companies. The U.S. is buying goods from these companies and sending U.S. dollars, into the French economy. Let's just say, right. And remember, this is before the euro, so all these countries are totally separate economically. They all have their own central banks, et cetera, et cetera.
Right.
And so those dollars come flooding in to France to buy goods. But the French economy is based on the franc, right? And so you have companies that have a bunch of dollars, and in order to pay their people and pay their rent and pay their mortgages and all that, and buy cars and all that stuff, they have to convert it to francs, right? Because they can't do that in France. And so in order to do that, the central bank basically has to issue a ton more of the local currency and really inflate the money supply. Which is one of the main things that causes inflation when you kind of get the money supply gets way out ahead of the economy.
Yeah, exactly. Well, and it's a great segue to kind of where we're going in the story with Bill Martin, because what ends up happening is that the U.S. is going to negotiate at this point an agreement with West Germany to try to prevent this kind of relationship from solidifying, where it would just be like a European bloc managing their own stuff without the U.S. So they basically sign an agreement with West Germany whereby West Germany is going to offset the cost of the troops that the U.S. is keeping in West Germany by paying for them. And it's not kind of a full offset, but it's a partial offset. And it doesn't completely stop the deficits, but it helps. And meanwhile, to your point on that issue, the issue of important inflation, Bill Martin works with the Treasury and with the European central banks to introduce a concept that they call the swap lines. And so swap lines basically allow, let's say, France, if you're the French central bank and you have too many dollars, your reserves are just kind of flooded with dollars and you don't want those, you can execute a swap line whereby you get francs from the Fed and the Fed takes the dollars that you have temporarily. And at some point that's reversed. Usually it was about 3 months, but it gives the opportunity to the French to not have so many dollars. And it's an alternative to converting them to gold, which the U.S. definitely doesn't want them to do. But it gives them the ability to have their own local currency that they can actually use for local kind of domestic economic activity, whereas the dollars just kind of sit there in reserve. So these swap lines are a big deal, and Bill Martin kind of quarterbacks this. And just for a brief minute, everybody's happy. But then, November 22nd, 1963, JFK is assassinated. And there's a panic in the markets. So there's massive selling. This was a Friday, right? So there's massive selling in the stock market. They actually shut down the market on Monday. So Monday markets don't open. And over the weekend, Bill Martin and the Fed moved to add a lot of liquidity. The market actually opens on Tuesday and stabilizes. I think the smooth transition of power to LBJ, along with Bill Martin's actions at the Fed, end up kind of smoothing everything over, and things are fine. But for a kind of hot minute there, things looked pretty dicey, like there was going to be another giant panic. And by the time LBJ takes over, Bill Martin has been running the Fed for over a decade, and he had built a really productive working relationship with Kennedy's team. And so again, mirror image of the transition from Eisenhower to Kennedy. When LBJ takes over, the LBJ White House is going to be very different. And since he was the VP, Martin kind of knows what to expect. There's a lot of continuity with the cast of characters in the LBJ administration, at least at first, but it's a much rougher kind of freewheeling approach to politics. And it makes Bill Martin a bit uncomfortable. And there's another reset, and he thinks briefly about maybe not, sticking around, but he does. And so he decides to keep working. Of course, then in 1964, LBJ goes on to win in a landslide his own term. And again, Martin tries to resign and give LBJ kind of, a clean start with a new Fed chair, and LBJ won't have it. They have big differences, but LBJ wants the stability of having Bill Martin, who by now is this like very well-respected figure in global financial markets, and he wants to keep him around. So fast forward again to 1965 a little bit, Martin gives a speech that is blown out of proportion in the press and becomes a huge issue, to the point that LBJ now considers, maybe I regret asking him to stick around, and maybe wants to fire him. And this kind of sticking point is that Bill Martin is really worried about the spending on Vietnam. And there's the Great Society programs that Lyndon Johnson's trying to get passed. And Bill Martin is nervous about raising rates and the implications for Fed independence, right? You've got Johnson, who's very powerful, who is known as a bit of a vengeful politician. And he has a lot of congressional allies because, of course, LBJ came up through the ranks in Congress, and he kind of knows where all the bodies are buried, and he knows how that part of government operates better than almost anybody else in history. And so the Fed does, in fact, end up voting to increase rates because they kind of see the writing on the wall. There's a lot of spending. They're worried about inflation. And so Bill Martin says, you know what, the right thing to do here is to increase rates. The FOMC is a bit divided, so they vote 4-3, so it's not unanimous. And so the combination of factors here lead LBJ to be really, really livid about this. And he actually calls Martin to his ranch and just tears into him. Just like, and anybody who has seen videos of LBJ or kind of knows the history knows that he could be just a scary person, not just because he's president, but just his personality, right? And so he tears into him at the ranch. And apparently Martin is kind of super calm. And he says, and I have a quote here, he says, "Mr. President, I warned you about it. You asked me to give you another chance. I did. We couldn't wait any longer to raise rates." So he's kind of very diplomatic and he's humble. And he tells LBJ that, hey, look, like the job of the Fed is to set interest rates. It's not the White House's job. So again, upholding Fed independence. And you could have seen this going one of two ways, right? On the one hand, LBJ could have gone nuclear publicly. I mean, in a lot of ways, kind of what Trump is doing now with Jerome Powell. He could have gone directly to that. What actually happens is that LBJ is very gracious and constructive publicly, kind of reminiscent of the Eisenhower episode that we talked about a little bit ago. And by the way, Eisenhower actually sends Bill Martin a letter. And in the letter, he compares him to the famous Supreme Court Justice John Marshall, who, for anybody kind of keeping track of their AP history, John Marshall is sort of credited with effectively establishing the independence of the judicial branch of government, and the Supreme Court is like the ultimate arbiter of whether a law is constitutional. And so in a way, Eisenhower is comparing Bill Martin to John Marshall for establishing the independence of the Fed. Like this over and over again, there's these precedents being established that the Fed is an independent institution. It is not subservient to the White House. I think at this point, one question that I had in the story is like, why do all these presidents come to rely on Bill Martin, despite, constantly being kind of challenged by him or sort of him being in their way politically? And I think it's because he's kind of this trusted person, and not just trusted domestically, but like he's trusted by private financiers, Wall Street. He's trusted internationally by other central bankers. He's kind of trusted by the general public. And he's established this reputation that he's going to do the right thing. Like he's not there to build his career or amass power. He's a guy that's trying to do the right thing for the country.
Another thing worth mentioning, right, is that when we look at markets today and the economy, everybody is hyper focused on the Federal Reserve as sort of the
like the quarterback of the world.
Room. Yeah, they're the elephant in the room in every market movement and discussion and attention and news and everything. It's worth noting that back at this time, they were kind of one of many players. I mean, maybe not one of many, but they were definitely a part of. There was a stronger thread of fiscal policy being involved in all this stuff,
right?
And it wasn't just relying on monetary policy.
Yeah, 100%.
So that may have been a contributor to why the relationships were tense, but never blew up into something where somebody was fired. Right? It's
not yet
because because it was a team. It was a little bit more of a team sport back then.
Yeah, totally. I think, well, that's a great segue because what's happening here, there's kind of an element of fiscal and monetary about the clash with each other here in a second, because what's happening is that the biggest problem of all of this is actually pretty circular, which is also, at the top of the episode, we talked about how hard this is to understand. Maybe nobody really understands it, is because it all sort of feeds on itself. Every time you analyze a certain variable, you sort of go right around the circle to the next variable that ends up at the first variable. And so you're kind of constantly trying to like circular kind of understand all this stuff. And the biggest problem is you can't solve the deficit problem, the kind of gold drain and the pressure on the dollar, without significantly reducing U.S. military presence in Europe at this point, right? Particularly in West Germany. But you can't defend against the Soviet takeover of West Germany, which is kind of the biggest chip on the board during the Cold War, without a military presence, right? And then on top of that, you know, we haven't talked about this, but on top of that, allowing West Germany to control their own nuclear weapons was a massive issue. And it would have been a massive escalation relative to the Soviets that I don't think would have been very well received, right? And so you can't stop military spending, but then that means more deficits. The deficits just continue to grow. But then that in and of itself threatens the ability to keep funding defense because it puts pressure on the dollar. And so you have this circular like Gordian knot issue. And then on top of all of that, you know, we touched on this, the US has to bail out the UK's pound, you know, almost every year in the 60s because their economy is a bit of a wreck and they have a lot of deficits. And so back to Bill Martin, you know, the niceties with LBJ after the reappointment are pretty short-lived because in 1966, it's pretty clear that the Vietnam War is burning a hole in the budget and pushing deficits much higher than have been forecast and draining gold from the US. And so Bill Martin starts advocating aggressively for a tax increase. So to your point, he basically is like, monetary policy can't achieve this on its own. We can't just keep raising rates on the one hand because, you know, rates were already relatively high, but also because I think Bill Martin realizes that politically, if the Fed keeps trying to do this unilaterally and raising rates on their own, he is going to come under a ton of pressure. And there's a world where Fed independence ends because of that, right? And so this concept of a tax is definitely not well received. And, you know, pressure builds with the White House. The White House doesn't want to do this. There is no appetite for a tax in Congress. And the market starts looking at this and becomes a bit skeptical about what's coming. So long-term rates go from 4.6% to about 5.5%. And there's this concept of a gold pool that has been established by the Allies that had set this up to stabilize currency issues. And, you know, particularly with the dollar and the pound sterling. And that breaks down. And so in November of 1967, Britain actually has to devalue by about 14%, which is huge. And the Fed sets out to defend the dollar because the market starts expecting that maybe the dollar is next, that the dollar is going to get devalued. And so, and Europe is really angry, right, that the U.S. hasn't gotten their balance of payments house in order. Like they've been talking about this for almost 20 years. That's a massive amount of time. So Europe is really mad about this stuff. Everyone's gold reserves are being drained. So now it's not just the U.S. at this point. And Americans abroad are having a hard time exchanging dollars. And so by 1968, Bill Martin calls this emergency weekend meeting of central bankers to try to figure out a solution. And there's two options here. Either they increase the official price of gold, so effectively devalue the US dollar from $35 to something higher, or they introduce some sort of two-tier system where the market kind of gets split and central banks can convert at $35, but nobody else can really go and convert their dollars. And so they go for the latter because Bill Martin's like, look, we don't have enough time before the market opens to do anything else. So we're just going to establish this two-tier market. And that actually ends up stabilizing everything. Bill Martin knows it's a Band-Aid, you know, without solving the fundamental kind of deficit issue. This isn't going to go away. And the way that I think he frames it is what's at stake. Well, one, the world losing faith in the US dollar. Two, another big gold crisis. And three, kind of a fracturing of the international monetary system. So a breakdown in Bretton Woods. And he says in a speech something that I thought was pretty bleak. He says, "We have been living in a fool's paradise. We face a financial crisis that is not understood by the public. There is no disposition on either side of the aisle in Congress to face up to the problems." So again, he's going back to this idea of we need a tax increase. Like we need to raise revenues so that the deficit decreases. And maybe even like to add context historically, like, you know, this is a pretty brutal period, right? The first half of 68, Probably one of the worst periods for any president in history. And LBJ is going through one. Vietnam is a disaster. By this point, the North Vietnamese, I think, again, going back to your AP history book, the Tet Offensive is like in full force. So Vietnam, there's no light at the end of the tunnel. There's riots in the streets in the U.S. The deficits are out of control. Dollar might collapse.
I didn't fully appreciate how much more spending happened on Vietnam than Korea, right?
Yeah.
So and Marshall Plan, right? So when you look kind of the four big things happening on kind of global spending were at, kind of through the 50s and 60s were Marshall Plan, defense spending, Korean War, and the Vietnam War.
Yeah.
And compared to Vietnam, the other three are non factors.
Yeah.
Right. Vietnam is just
it's expensive,
huge amount of spending, and not many more troops than Korea. Actually, apparently it was all like logistics and ammunition and things like that. That caused that it was like 3.5 times more spending than Korea was. So you have like a real different situation when it comes to spending on defense here.
It's not an easy thing to navigate. And then on top of that, at this point, LBJ is under political pressure from his own party. And so Robert Kennedy announces that he's going to go for the presidency. It's an election year. And then, of course, later in that year, things just get worse. Martin Luther King gets assassinated. Robert Kennedy himself gets assassinated. All of this put together, LBJ actually decides he's not going to run again, which kind of foreshadows another decision point for Bill Martin here in a minute. But the other key piece is that inflation is at its highest level in like a decade and a half at this point. It's crossing 4%. GDP growth is massive. So to your point of all the spending, military spending and all the Vietnam stuff, the economic growth, nominal economic growth is about 10%, which is huge. So the economy is running really hot. Yeah, really, really hot. And, this time, maybe because there's Congress finally gets religion through what LBJ is doing to raise taxes, and they do kind of push it through. In Bill Martin's mind, not soon enough, but maybe because of that and because LBJ is not going to run again, and Bill Martin wants to kind of ensure a smooth transition and Fed independence, he actually starts to think about holding rates steady rather than hiking too aggressively. Even though technically the economy is running really hot, there's forecasts out there at this time that say that there's already a slowdown, and so they're thinking maybe we don't need to raise rates. But either way, Nixon wins the election of 1968. And maybe that's also part of why Bill Martin decides it's time to ease a little bit. And so Nixon, I think for historical context, does not like Bill Martin because he blames him for his presidential loss against JFK in 1960. He thinks that he was famously the VP for Eisenhower and he was running for president. And he thinks that Bill Martin's Fed affected his ability to win the White House that year by keeping monetary policy too tight. I think another key data point of all of this is that Fed governors have a 14-year term. And so now it's not just the presidential appointment of the chairman that is going to limit Martin's ability to kind of stick around, but also the fact that his 14-year term as a Fed governor is coming to an end, and it expires in January of 1970. And so he's thinking, well, okay, Nixon won, maybe this is the time. Nixon says that he actually wants to nominate somebody else. So they meet. Nixon and Bill Martin meet in December of 1968 in New York City. And so Nixon is trying to, Nixon being Nixon, is trying to reposition Bill Martin. He doesn't want him at the Fed. And he actually offers him the role of Treasury Secretary, to which Bill Martin says, I intend to serve out my term as the Fed chairman, and declines. And then Nixon's super disappointed about this. He wanted to name Arthur Burns. And so it's a super awkward meeting because Nixon responds, well, I will just appoint him when your term ends. So they sort of like part ways. Martin tries to convince Nixon to extend the tax cuts in 1969 because they were going to expire. And Nixon actually had campaigned against it. Nixon is interesting. Nixon does not care about economics. I think Nixon just completely ignores him, doesn't care about economics. This is not the thing he's focused on. This is not what he ran on. It's not what he's interested in. Martin starts to think that if he tightens really aggressively, the Fed might come under fire from business and Congress and the White House, certainly. And it could be really, really bad because Martin expects the fight with inflation to be hard and pretty long. and he wants to set the Fed up for success. And ultimately, he's right. Spoiler alert. But the Fed ends up racing just by 0.5 percentage point to 6% at the beginning of 69, after inflation had already increased past 4.5%. A giant rift opens between the White House and the Fed. The idea from the White House is like, look, yes, the economy's running very hot. We need to fight inflation, but we can do that gradually. And Bill Martin is like, no, look, I've been around long enough that I understand how this works. You have to fight expectations. Like, psychology matters here. And if people expect there to be a lot of inflation, that will become a self-fulfilling prophecy. And the White House is not having it. And so by the end of 1969 in October, Nixon announces that Arthur Burns is gonna take over. And economic data is deteriorating. The FOMC is actually leaning towards easing at this point because they're looking at the deteriorating economy more than inflation. And Burns himself is coming out publicly saying that the Fed, when he takes over, will be easing monetary policy. And so Martin decides, I'm not going to fight this battle. I'm gonna just go with the momentum here, and he moves to ease as well. And so they lower interest rates. And in some ways, tragically, I think Bill Martin leaves the Fed feeling like a failure, which is interesting because to me, he's probably certainly the most impactful, if not even the most successful Fed chairman of all time. And so, despite building the modern Fed, and some in the things that I read even call him basically like the most important economic policymaker since Alexander Hamilton for the U.S. In his farewell party, everybody's giving these speeches at the White House, including Nixon, that are kind of praising him, his tenure and his character and all these things. And when he gets up to speak at the end, he actually apologizes for the situation that he's leaving behind. And he says that the country is in deep trouble. And that's like the end of his speech. And it completely brings down the room, as you might imagine. And Bremer in his book makes a joke that, like, even at the end, he's taking away the punch bowl just as the party's trying to get started. But as he's exiting, I don't think he's wrong, because as he's exiting, all these problems with the dollar and with gold and inflation are they're about to come to a head in a very big way. Some might say a very shocking way.
The nice illusion. The two things there. One is the response to inflation picking up. That was termed gradualism in kind of the Nixon administration. And one major thing we're going to learn is that they're going to give up on gradualism pretty quickly in the Nixon administration. And then second is Nixon's about to, we're right at the time period now where Nixon's about to have his second major political loss due to what is called the economic issue, right?
Mm.
So he lost, he ran for president in 1960 after being Eisenhower's VP, and Kennedy ended up coming in and winning because, Nixon believes at least that the Fed tightened and they took the economic issue away from the conservative party. And now here we are again in 1970. The same economic issue causes Congress. There's a congressional elections in 1970, and that causes Congress to shift and become controlled by the Democrats, which nothing I read really talks about this very much, but it is worth noting that in order to change the official gold price, you need congressional approval.
Yeah.
Right. And
right.
So it seems like this shift of Congress in 1970 actually took that off the table, right? As like one of the ways that the Bretton Woods imbalances could have been dealt with over the next couple of years.
Yeah. Yeah. Well, I think that's a good spot for to foreshadow or leave it on a cliffhanger as to what's going to happen here pretty soon. So that's where we'll pick it up next week.
All right. Let's do it. Looking forward to it.
All right. Thank you. If you enjoyed this, the best way to help us is to share it with anyone you think might like it, and to leave us a 5-star review on Apple Podcasts and Spotify. And of course, to tune in for part 3 of the series next week.